Hello, everybody. My name is Paul Buitink, and today I have the honor to have Alasdair Macleod on again. Alasdair is head of research at GoldMoney.com, and he has published a great deal of interesting articles on inflation, interest rates, gold, Bitcoin, and central bank digital currencies. I look forward to covering all these topics with him. Hi, Alasdair. Good to see you again.
Hello, Paul. Good to see you too.
A lot going on in the world at the moment, and this week was particularly interesting to see what the Fed thinks about the economy and how they expect inflation to develop and what they're going to do about it in terms of their interest rate policies. Could you summarize what the Fed decided this week?
Yeah, it's interesting because so far, as I'm sure anybody who has any interest in what the Fed says, they have been insisting that inflation is, well, first of all, it was transient, and then it sort of went into Never Never Land. There was always the hope that it would somehow disappear, if you like, as a problem when supply chains got themselves sorted out and so on. But clearly that's not going to be the case for some time. And the other thing that's wrong with all this is that the Fed has been pushing the idea that price inflation is inflation. And it's got nothing to do with changes in the quantity of money. And bearing in mind that since the great financial crisis, or the Lehman crisis, I prefer to call it, really because I think there's going to be a greater financial crisis down the road. Since the Lehman crisis, the quantity of money measured by M2 has tripled. You don't increase the quantity of money like that without there being consequences for prices. And if you look at independent analysis of the effect on prices, it's been consistently higher than the Bureau of Labor Statistics have said with their CPI calculations. So, the monetary effect on price inflation is very severe, and it is continuing, and it is accelerating. I think this is really what Powell is now getting a bit more worried about. And he's pretty late into this game because I've been calling this for some considerable time. And I don't have the advantage, if you like, of all those PhDs surrounding me. Or perhaps that's a disadvantage. He's got all the PhDs surrounding him, telling him Keynesian rubbish. And I think that is fundamentally the problem that he's had. And I think in the sort of comments after the release of the FOMC minutes, it became clear that he is a bit more worried about the inflation situation than the FOMC minutes suggested. And it was that has led to market reactions. The market reactions are typically Keynesian. They are completely nonsensical too, because we now have the prospect of higher interest rates than we had before. So what do? They mark up equities. What? That's nonsense. They mark down gold, completely forgetting, well, two things. First of all, the experience of the 1970s, when we entered that decade with interest rates roughly half of where they were, where we exited. And yet the price of gold went from $35 to $850. So the idea that higher interest rates are bad for gold is complete nonsense. So that's the first thing. And the second thing is they don't understand what the role of interest rates is. The role of interest rates is basically to compensate holders of a fiat currency for loss of possession of that for a period of time. So if, let us say, you lend your dollars to someone for a year, you would expect to be compensated for, first of all, the loss of that possession, which the economists call time preference, and also for changes in the purchasing power of that currency. And if the purchasing power of that currency is going down the toilet, then you expect quite a lot of compensation for it. It's not a question of using interest rates to try and manage the exchange rate. They've got it back to front. So we are, I think, on the cusp of a very difficult and interesting situation. And this idea that, if you look at what the market's trying to discount in terms of interest rates, I don't think many people sort of expect at the end of 2022 to see dollar interest rates of over, say, 1.5%, 2%. But the experience of monetary expansion in the 1970s was that expanding at half the current rate that we have seen, interest rates went to 20%. I mean, this is just the idea that, this is just a little temporary road bump, as it were, and we'll all return back to zero interest rates. Forget it. This is a very serious situation. It is the beginning of a trend which nobody expects. I don't know whether Jay Powell suspects it, but I think he's beginning to worry that this is going to be a bit more serious than they've been letting on so far.
So he was actually quite hawkish then, and he seems to be getting the message then, in your view? Or?
Well, I mean, he was a bit more hawkish than he has been. But I mean, quite honestly, he has not been hawkish at all. So we're talking about a very, very minor change in direction compared with what is coming. I mean, no central bank can afford to consider a situation where they end up issuing treasury bonds with coupons of 10, 12, 15%, which is actually what happened in the 1970s. I mean, in the UK, with literally half the monetary violence that we have had recently, we issued 3 gilt stocks, one with a 15% coupon, a 15.25% coupon, and a 15.5% coupon. Just imagine what even half that would do to the debt situation in the private sector, the debt situation for government. I mean, it would be absolutely catastrophic.
Right, because in the 70s, we didn't have these debt levels that we have right now. So our current economy or our current debt-addicted society cannot handle these types of interest rates at all, let alone half of these rates, or not even half of these rates.
You're absolutely right. I mean, in the UK's case, they did have a debt problem. And because they had a ballooning budget deficit, the IMF were called in to rescue, would you believe, rescue the UK economy by injecting £1 billion into it. Now, £1 billion in those days was a lot of money. I mean, £1 billion, not nothing, spare change for a cup of coffee. Well, not quite, but, we had that problem at that time. And it was the IMF that forced a Labour government, a socialist government, to cut back on its planned expenditure. Eventually the thing came right, but not before we issued these gilts, as I said, at 15% plus coupons. And you're right about the relative levels of debt, because the private sector debt only really exploded, apart from mortgages, it only really exploded after the great financial crisis. And it's just gone up and up and up since then. And that was not the great financial crisis, I should say, the Big Bang in London, when basically, banks switched from lending money to Main Street to speculation, if you like, lending money for speculation, increasing financial services and all that sort of stuff, buying stockbrokers. I mean, there was an explosion of debt, which really started from that moment. So this is going to be a lot worse. Of that, I have absolutely no doubt. And not only that, we're not just talking about debt in dollars, debt in sterling, we're talking about debt all around Europe now. And that is a very serious situation. I mean, how does the ECB move itself from negative interest rates into positive interest rates, taking bond yields from negative interest rates into positive interest rates? And I'm not talking in real terms, I'm talking nominal terms. It's the whole of the bond markets are completely mispriced for the current inflationary situation.
Yeah, because that's the thing that puzzles me. I also talked to Jeff Snyder on this show, and he's of Alhambra Investments, and he always points to the yield curve, saying, look, the yield curve is flat, and looking at the yield curve, it looks like bond traders or investors don't expect a lot of inflation in the long run, because otherwise they would have asked for higher nominal yields. What do you think of that? Because apparently there's no inflation to be seen in the future.
Yeah, I mean, I think that analysis makes sense, because the condition of a flat or a negative yield curve is one where the short-term rates are higher than the long-term rates. And that is usually, it's like having a backwardation, if you like, in commodities. It's not a natural situation. The natural progression is you have low interest rates for overnight money, cash is zero. I mean, it's always zero. But as you progress out in terms of time, the rate should go up and up and up, because why? It reflects the increased risk that you're not going to get paid your money back. It's actually no more complex than that. So if you've got a flat yield curve, what it's telling you is that the market thinks that short-term rates are too high for the long-term risk. What? I mean, this is just completely nonsensical. And this is why I still say that the markets are horribly mispriced. To give you an example, the 1 year Treasury bills are currently yielding, I think, something like 0.7, 0.8%. Yet 1 year's inflation, as recorded by the CPI, is 7%. So you've got negative minus 0.6%, sorry, minus 6% plus yield on US Treasuries. And if you take shadow stats figures, I mean, they think that the rate of inflation at the moment, properly expressed, is over 15%. Then, I mean, you can see this is just bizarre, completely wrong.
But isn't it like, if the market is mispriced collectively, it's such a huge bond market, isn't it? It seems a bit difficult for me to believe that the whole market is misguided, and then us gold bucks see the market and the future in the right perspective. It's sort of this mismatch is a bit puzzling to me.
Well, yeah, I mean, the way to understand it is that the market believes, and this is something which is either right or wrong, that markets no longer matter and the Fed can control the markets. Now, if you believe that, then good for you. But I would say that it's essentially a Keynesian belief that this is what should happen. The reality always is, and we've seen this with fiat currencies going back for thousands of years, the reality is that governments do distort things with what they do with money, and eventually the market reestablishes reality. And that is going to happen. It's as simple as that. The only thing we don't know is when. And that is always the very tricky thing. But I mean, we've got this financial system where everybody is enthralled to the Fed. If you look at the mainstream media, they are all Keynesians. They're trained in universities to be Keynesians, and they will report what the Fed wants them to report. Why? Because if they don't report what the Fed wants them to report, then they don't get invited to the briefings, and off the record briefings. If you're a journalist in mainstream media, then you find, you're not invited anymore. Your editor starts saying, well, we're not getting the information that our competitors are getting, so you're sacked.
Yeah.
I mean, it is a fix. The whole thing is an enormous fix, and it'll come tumbling down. Of that, there is absolutely no doubt.
And do you feel we're going to have a recession too, or maybe not even stagflation, if you combine higher inflation with the recession over the next few years?
Well, stagflation is a misnomer, really, because there's a sort of Keynesian thought that you either have an expanding economy, in which case prices will tend to rise, or you have a contracting economy, in which case prices will fall. I mean, this is, simplistically, that's what they appear to believe. But, a moment's thought shows that actually what they're forgetting in all this is that you do have a changing purchasing power of the currency. And if you, sort of go back to the years of the 1920s, the early 1920s, when you had inflations all around Europe. I mean, I think you certainly had it in Germany. We know about that. We had it in Austria. We had it in Hungary. And we also had one slightly earlier in Russia. The situation then, if you just imagine that you are living in Germany at the time of the inflation, they didn't measure it at the time, but GDP measured nominally in marks would have been off the scale. Why? Because the purchasing power of the mark was going down very rapidly. You go out, you go out into the streets of Berlin or Hamburg or wherever it might be, and just see how wealthy people are with that situation. They were bust. They were starving. That is the effect. So the idea that, sort of nominal GDP or prices rising is always accompanied with an expanding economy is patently rubbish. I mean, it just does not happen. The point about inflation is that if you have monetary inflation, you are transferring wealth from the population, the wider population, to the issuer and those who are closest to the issuer. I mean, this is something which we now know as the Cantillon effect. You can't have it both ways. You can't transfer wealth from your private sector, the engine, if you like, of economic progress, to the government, to the central bank, to the banks who are licensed to expand credit, without suppressing, if you like, the potential of the market. And the faster that transfer goes, the worse it is. And we're now in that situation. As I said earlier, from the Lehman crisis, the expansion of the quantity of money has been 3 times. I mean, so how much wealth is left, if you like? Did taxes go down to compensate? No. So there's absolutely no way that this situation is, can be described as stagflation. I mean, stagflation is a portmanteau word. I know this because it was actually invented by my uncle. If you look it up in Wikipedia or whatever.
That's interesting. Okay.
I mean, it was when he was Shadow Chancellor of the Exchequer. I'm going back into the 1960s, and he described a situation basically where you had wage inflation on the one hand, and you had a deflation, if you like, in terms of I think it was something like the volume of steel, the value of steel production. We were talking about steel workers in those days, a nationalized industry. So it was very, very specific. It was never intended to describe a situation which only the Keynesians seem to think exists, and that is that you can have prices rising, or you shouldn't have prices rising while at the same time the economy is tanking. To them, this is just completely illogical.
Right, but if you only look at history, you will find out that it's very common indeed.
Well, I mean, it goes with it. If you're going to impoverish people and just, fiddle the numbers, then that's what you get. And that's basically what it is.
Yeah. So we started with the US, and we've noticed then that possibly Powell is becoming a little bit more hawkish, but most likely he will be too little, too late with his actions. And by the time he starts raising interest rates, inflation will be even much higher. And the same, of course, is going to happen then in Europe, I assume. Are you expecting in Europe the same trajectory? And do you expect the ECB to also start raising rates then anytime soon?
Well, I feel sorry for you Europeans in the Eurozone. I really do, because the ECB has not got a clue what it's doing. It's got itself even more trapped than the Fed.
They have less space, right? Because they cannot, they're like you say, they're much more trapped than the Fed is.
Yeah, I mean, you've got negative deposit rates at the ECB. And if we just concentrate on something that is unique, if you like, to the Eurozone, what's happened with negative interest rates is that the cost of doing a repo in terms of the interest cost is zero, literally zero. So what's happened is that the repo market in Europe has increased to over 10 trillion euros. Now, this is enormous. So this is no longer just a market, if you like, whereby, Bank A, has a liquidity shortfall, which it needs to cover overnight. So it does a repo with Bank B in order so that it can balance its balance sheet. No, this is become a monster, and a lot of it is hiding debt. And the reason this happens is that if, say, the Italian banks, for example, they have bad debts, and we know that if you go back 5 or 6 years, the bad debt level was horrendous. I mean, it was something like 11 to 12% of GDP, which, when you take account the private sector in Italy is only half the economy, meant that roughly a quarter of private sector GDP, as it were, was bad debts. I mean, this was appalling. So what does the local regulator do? The local regulator turns around, I'm talking about the bank regulator, and says, I tell you what, I will say that those debts are performing. I don't care what you say.
Yeah.
You can now use that as collateral, which you can now borrow money from the Banca d'Italia. the Banca d'Italia, where I've spoken to them, they're quite happy to do this because they know they've got no alternative. They will lend you money against those bad debts. Those bad debts now move out of the Italian economy into the Target 2 settlement system. And we feel that that is the best way to deal with it. So what you have is you've got all the imbalances building up in the Target 2 system, a lot of which, not all of them, but a lot of them are, sort of hidden bad debts. Now, this isn't the total of the 10 trillion, over 10 trillion of repos and reverse repos that I was talking about, because a lot of it is between individual banks. But this is a situation against which, just imagine what happens if you now get rising interest rates above the zero bound. This repo market is going to start unwinding. And we're talking about a massive unwind, which is far bigger than the capital of the euro system. It can't handle that. And not only that, but if you look at the global systemically important banks, look at their balance sheets. Their assets to equity ratios are well over 20 times. And you're sort of looking at 23, 24 times, something like that. Some banks a lot more. I mean, some of them are up to over 30 times. They can't take any disruption at all. The idea of rising interest rates, and this can be somehow ridden through, forget it. So I actually think there's a very strong possibility that the next financial crisis, which I feel is imminent, will probably emanate from the euro, and it'll probably emanate from the euro because of the effect of rising interest rates. And when that happens, I think it will just blow the whole euro situation apart. I mean, I can't see how the ECB can get out of it. And I think that, I mean, underlying this, you've got this long-term problem that, the Germans, the Dutch, the Finns, the Luxembourg bourgeois have basically been savers, and they've been lending their money to the spendthrifts, France, Italy, Spain, Portugal, Greece. That money is gone, it's written off. And the one thing that has not happened yet is that people in Holland, people in Germany, people in Finland and people in Luxembourg, they haven't actually either realized or had the courage to stand up and say, then enough, that is it. We're not going to be part of this anymore. When you get the systemic banking crisis on the scale, which is now inevitable, I think it'll just blow the euro apart.
But that's interesting then, and even ironic that the ECB, who is supposed to keep the euro together, to do whatever it takes to save the euro, is actually then the entity that will trigger the crisis.
Absolutely.
By raising rates.
Yeah, I mean, they've pursued policies which are, which will ultimately lead to this destruction. I mean, as I said in a slightly different context before, I mean, we know where this is going, we just don't know when.
So then that's why they're so hesitant when it comes to raising rates, and that's why they probably prefer having high inflation for many years, because that also makes the whole debt burden more bearable. And they would rather suppress yields and keep inflation high than to trigger the downfall of the euro.
And you have got a president of the ECB who wants to, sort of borrow even more in order to invest in environmental, non-fossil fuel technology. I mean, come on. And there was a joint letter by Draghi and Macron in the Financial Times in sort of mid-December, before Christmas, sort of making the case that they ought to be able to borrow more. Yeah. This is just crazy. I mean, and if you look at the average level of debt to GDP in the Eurozone is now over 110%. And this is with governments which dominate their economies. And if you adjust the figures for the size of the private sector, which is what you should do, you should be looking at government debt compared with its tax base. And the tax base basically is its private sector, because you can net out government employees and all the rest of it. And I mean, the figures are just horrendous. I mean, you're looking sort of 300, 400%.
Yeah.
There's no way it can be sustained.
And it seems now that governments are completely addicted and used now to running high deficits and to borrow the deficits. And the Maastricht norms are not at all applicable anymore. So it's very difficult to put that cat back in the bag.
Yeah, I mean, do you see any government talking about controlling their spending? No, not at all.
No, because first it was COVID, and next it will be the Green Deal, and so there will always be a reason to keep on spending and to keep increasing the debt until the moment where people are just, especially in the north, are fed up with it, and that will probably be because of persistent high inflation. For now, maybe a lot of people will still buy the idea that it's transitory, but at some point, if it's for a few years in a row, then they will demand change.
I don't think that's quite how it works, Paul, because people don't sort of get to a point where they say, enough is enough. What will happen is that you will have a financial crisis that will just blow the whole system apart, and it is subsequent to that, I think, that the Germans and the Dutch and so on will realize the stupidity, and it will release them, if you like, to go their own way in monetary terms. And that is, I think, I'm just fascinated to see that Jens Wiedemann resigned, asked for early retirement as head of the Bundestag.
His conscience was just telling him to stop.
I had a lot of respect for Wiedemann, and he was asking some pretty embarrassing questions of the ECB about Target 2 settlement system, for example. Certainly, I don't think getting satisfactory answers. He could see this thing's going to blow up. I mean, I'm glad he resigned, because I think what will happen is that when it blows up, the talk in Germany will be the reintroduction of the Deutschmark, and they will need an Erhard, Ludwig Erhard, if you like, a contemporary one, to come back in and to oversee the introduction of a replacement German currency.
Yeah, but it can only be blown up then when the rates are going up, right? Or do you see another trigger event that could lead to this massive financial crisis in Europe? Because the rates are then probably not going to be raised anytime soon because of this threat, this looming threat. So are there any other trigger points that you see?
Well, yeah, I mean, it's either the ECB reluctantly raises rates, or the purchasing power, or if you like, the exchange rate as well for the euro just tanks. I mean, if you look at what's happened recently, the two weakest currencies with this interest rate rise story, which is now developing, have been the euro and the yen. And these are the two currencies which are on negative interest rates. So, that tells you as much as you need to know about how this situation is going to develop. I mean, if let us say the Fed increases interest rates by 1 or 2%, and the euro, the ECB decides to try and do absolutely nothing about it, then it's going to kill its currency. And what are you going to see in terms of inflation rate? The inflation rate is going to be even higher, but it's already even higher. If you look at energy prices and what's happening as a result of the Russian-Ukraine situation, particularly, I mean, all around Europe, natural gas prices are far higher than they are anywhere else in the world. So, you've already got prices rising considerably faster than elsewhere, and a weakened euro is just going to make that thing worse. So whichever way it cuts, I'm afraid the ECB has had it.
Yeah, it's interesting to see that the Bank of Ireland is possibly already anticipating on something in the future that's going to be destructive for the euro, because they've started buying gold as a central bank. You've probably also seen the news, right? So what do you make of that? Well,
too little, too late, I think is about the only thing I can say. But I think they're moving in the right direction. I'd be more worried, actually, about the sterling situation, because, infamously, Prime Minister Gordon Brown instructed the Bank of England to sell 2/3 of our gold, going way back, and they actually hit the bottom of the market under $300.
Yeah, Brown's bottom.
Brown's bottom. God. Anyway, I mean, if the official statistics are right, that gold has never been bought back. So, the Treasury figures have never been altered since that extraordinary episode. We're still stuck with something like 340 odd tons or something. But then you've got other countries like Canada. I mean, they've got rid of all their gold. And this is crazy, absolutely crazy. And I mean, we're talking about a G7 country. At least the European nations have hung on to their gold. Well, I mean, we assume they have because, of course, we don't necessarily believe the statistics. I mean, if you go back to the year 2000, 2002, there was an analyst called, I can't remember his Christian name, Venerosa, who made some very serious inquiries into the level of gold leasing by central banks. And he came to the conclusion, I think he made a speech in Lima in 2002, where he revealed his findings that anything between 10,000 and 15,000 tons of central bank gold had been leased into the market, possibly never to return. Now, at that time, we were talking about up to half the gold actually held by central banks. Quite a lot of the leasing activity continues. We have no idea, out of the 35,000 tons said to be in global central bank gold reserves, how much of that is leased today. But there is probably quite a lot of it, which is in effect double counted and therefore doesn't exist. Yeah. So, this is going to be an interesting exposure.
What do you think of countries such as El Salvador that are actually betting on Bitcoin instead of gold? Do you think that's a smart decision?
No, I think it's very stupid. Because they assume that cryptocurrencies will fulfill the role that gold has always fulfilled in the past when fiat currencies fail. I mean, they're going against history. Even before we go into start arguing about the economics of the situation. But the reason Bitcoin will never work as a currency is because you cannot invest in production by borrowing Bitcoin with a view to paying it back at the end of your production process. Why? Because you've got no idea what Bitcoin is going to purchase in terms of the goods that you're producing. I mean, because, if let's say you're making motor cars, right? Okay, let's say that, you borrow the Bitcoin today in order to invest in a new production line. And just make it very simple. We'll say that one Bitcoin is what you expect, that's the sort of car that you're going to be making. You can buy it today for one Bitcoin. But after you've built the factory and all the rest of it, and the stuff is rolling off the factory conveyor belt in 10 years' time, what is Bitcoin going to be? Now, with gold, you knew because it was stable. It had been stable, with a bit of variation, admittedly, but its purchasing power was stable century after century after century after century. But with Bitcoin, I mean, you're going to find the situation, if that was to become money, you'd find that its purchasing power would rise over that 10 years and it would bankrupt you because you wouldn't be able to pay it back. So it's complete nonsense. And this is even apart from the problem of getting non-tech savvy people who are like 99% of the planet to accept something which they don't understand as money. I mean, it's just not going to happen. So El Salvador, I think, has made a huge, huge mistake doing this.
Yeah, I'm a big fan of the innovation that's taking place in crypto, and I like Bitcoin. I own some Bitcoin. I see some of course, the issues, and the volatility is an issue. But of course, you could argue that that's something that will go away over time, just like gold needed its time to become stable. Bitcoin needs time too. Of course, God knows how long it will take, but let's just hope that volatility will
5,000 years.
I don't have that time, unfortunately. Hey, and Alasdair, you also wrote something about central bank digital currencies on your latest article. Just this week, the Fed came out with a consultation paper, and also in the Eurozone, they have been releasing a lot of papers, and they're actually thinking about this digital euro to be released in 5 years or so, or to be launched in 5 years. In China, they're already much further ahead of the curve. Do you think we're going to see central bank digital currencies in the US, in the UK, in Europe over the next few years or so?
No, I don't. Obviously, there's a lot of research being done. It's being, if you like, coordinated by the Bank of International Settlements. And on the committee are representatives from the major central banks, with the exception of China. So you've got the Fed involved, you've got the Bank of England involved, you've got the ECB involved, you've got the Bank of Sweden involved, I think, and you've got the Bank of Switzerland involved. So, I mean, these are, if you like, the sort of respectable leaders in the central banking community, if I can call them that. The problem we have with it is that essentially what a CBDC does is it allows you and I effectively to have an account at the central bank. And eventually when cash is replaced by something else, it is likely to be a CBDC, because when you get a banknote, the banknote is a liability of the central bank. Now, instead of that, what we will have is an electronic connection into the central bank, and we will have to have an individual account through which CBDCs flow. So when we buy something, we pay, if you like, via a debit card or via our iPhone or whatever, but instead of it coming out of our bank deposit or the facility given us to us by a commercial bank, the counterparty, or if you like, will be the central bank. So we're talking about a major change which is going to require central banks to get involved in territory for which they're not currently equipped. When you take into account all the individuals and all the businesses who would use this facility, it is a massive undertaking to provide this facility for the economy, absolutely massive. That's the first thing. The second thing is that what is happening with it is that central banks are moving into territory which is currently occupied by commercial banks. Now, this is important because on the one hand, we've heard nothing from the commercial banks about this, but it means taking business away from the commercial banks. Are they going to be happy with that? But far more importantly one has to understand how a commercial bank works. What it does is it creates money by lending it into existence. And when, let's say I'm a commercial bank and you are borrowing money and I agree to lend you money, what I do is I credit your account on both sides of my balance sheet, because it's double entry bookkeeping. On the one hand, I have an asset, which is my loan to you. And on the other side, which will match it absolutely completely, is the facility that that asset represents. So that will appear as a deposit. Now, I don't actually send a note to you saying that this is your deposit. No. But in terms of my own accounting, that is what happens. Now, just imagine if the deposit side was taken away from me and put into the central bank in the form of CDs, central bank digital currencies. Now, that means that suddenly my accounting isn't going to work. Where am I going to find the balance? Now, nobody at the moment is talking about this, but this is a very major issue. And there is a subsidiary issue about that. And that is, let us say that you have got a deposit with me as the bank, and you think, hold on a minute, I think that, it's a bit risky having money deposited with Macleod bankers. Really, I think what I would like to do is take my deposit out and move that deposit to the central bank. Now, you could do that like that. So I could find that if there's a rumor or something like that, there's a run on my bank, on my business, and it's all going into the central bank. And it's not queuing up outside the branch saying, I want my money, give it to me in cash, which I could always turn around and say, oh, money laundering, you've got to prove what you're going to do with it and all the rest. I can delay it. And indeed, I'm instructed by the bank regulator not to pay out large amounts of money to my customers. I mean, we're now in a situation where customers can just literally take it and go whoosh, and it's gone. And
yeah, but then of course central banks will step in. Central banks will step in. Yeah, but central banks will step in and provide with a loan. Like in the end, it's all money managed by the central bank. So central banks will not allow that bank to go belly up. They will just substitute that for funding.
that is the situation at the moment. And the reason that a central bank can do it is because they get at least a little bit of a warning that this is a developing situation. But if suddenly, intraday, I've just lost a whole load of deposits, this is going to be a very difficult situation to catch, if you like, as far as the central banks are concerned. I mean, I do take the point that is the function, one of the functions of a modern central bank, and that is to backstop the whole banking system.
Yeah.
But this is, I mean, do you want to get into a situation where you've got a banking crisis every 5 minutes potentially? No, I don't think so.
No, I agree. And also one of the main reasons they wanted to launch a central bank digital currency was because of Facebook announcing Libra. But I read this week that Facebook is actually, or the rumors have it, that Facebook is trying to sell off or Libra and Diem are trying to liquidate it. So I guess that threat is gone. Then maybe the advent of cryptocurrencies could be another reason for central banks to come up with their own currency. But I guess the banking lobby is strong enough over the next few years to make sure that their bread and butter is going to be untouched.
Yeah, well, bear in mind also, that's a very good point you make, because in America, the banks basically backstop politicians' election expenses. I mean, huge donations to both, the Democrats and the Republicans. And what this means is that the banks will tell the politicians how to vote. And if the banks don't like it, this is not going to get passed, because a dollar-based CBDC is not going to come into existence without legislation. It will require legislation. So I think the banks would stop it at that point. So, overall, I don't see this happening. And not only that, but the time taken to get this thing on the road. I mean, 5 years? No, it's going to be more like 10, 15, perhaps even 20. And yet we are on the verge of a crisis. If we get interest rates rising, as I believe we will, and all the indications are that I'm right, then this crisis is this year, not in 2030.
Well, some words to think about. Thanks a lot, Alasdair, for your time. Anything else you would like to add to the conversation?
I think you've covered an awful lot, so I haven't really got much more to say, but it's been a great pleasure.
Yeah, perfect. And I advise people to go to goldmoney.com and look for the research section where you can find all of Alasdair's articles. And of course, I'll also put them in the show notes. So thanks so much, Alasdair, for your valuable time. And let's do it again in a year or so.
If not before. Thanks very much, Steve.